You have a pretty small amount of capital to invest in the stock market, but where exactly do you begin? If you have just a couple $100, we're going to be looking at exactly where I would put it if I had to start over. Now, when we think of growth stocks haven't been very cheap. We've seen a really big demand in the tech sector. AI has really been driving crazy. The Nasdaq is up a blazing 36%. Even the S&P 500 is up roughly 26%. But if you're buying individual stocks, I would really advise you not to. The reason being the risk factor that is going to come with it. You could be buying some of these large tech stocks really at the peak or the pinnacle of the growth that we see, and there could be a market correction. Could see a little bit of a buyback. Now, this is the reason why I focus in only exclusively on ETFs. I do not buy individual stocks. I do not hold individual stocks. So if I had a couple $100 to put into a growth ETF with exposure with hundreds of stocks inside this ETF with a single purchase to make it very, very easy, there is only one choice that I would do that I do hold as well. Personally, in my investment portfolio, that is the Vanguard Growth ETF or the VUG. Now, with the VUG in my portfolio, I have a 4 ETF portfolio that I have over $100,000 in. And with the VUG itself, it is the best performing ETF that I do have in that entire portfolio. So I want to break down exactly why it is the best and really the reason why I do invest in it. Now, of course, I have Vanguard funds, I have Charles Schwab funds, I have the QQQM. So I am not loyal to really any ETF or any company that offers these ETFs. But overall, when you look at the ability for a fund, for an ETF to grow exponentially, this one still has a long ways to go. So now looking at it right now, it's about $340 a share, but giving it is going to give you roughly just over 200 large capitalized growth stocks. That is right. You are buying the best of the best when it comes to growth, which is the reason why this ETF is performing so exceptionally well. Now, when you look at some of the key metrics, over half of the Vanguard funds are invested in the tech sector, which we know to be true. Price to earnings ratio is 37 compared to a very wide market of 21. And the companies in here have roughly a 20% annual rate. So again, well above the S&P 500 or the VOO that we have seen. This, of course, is focusing on the fastest and largest growing stocks that we have, even if you're looking to pay a premium. Now, one of the big things to remember with these Vanguard funds is the efficiency and the cost. So if you're putting money into the VUG on $10,000 invested, you are paying $4. That is right. It is $4 with a 0.04% rate, which is kind of crazy. When you look at very similar growth funds, they're roughly running $100 per 10,000 invested or even higher, which exactly is what we're seeing. So the VUG also does not have a very high turnover, meaning that they're not jumping in and out of stocks. They are keeping this really low when it comes to the cost because they're not doing a lot of trading. Now, this one does also have $226 billion of assets under management. It is one of Vanguard's absolute most popular funds. And again, personally for me, it is the best performing fund. But guys, before we get into the next part of this video, go ahead and subscribe to the channel, give it a thumbs up, and let me know in the comments if you hold the VUG in your personal portfolio. Now, of course, with the composition of this ETF and the risks that come with it, it is really wider in a couple months. In the past year, this has returned roughly 38%, which again is kind of crazy. So a lot of people are saying could see a market correction. You could see a little bit of volatility, but overall, this is something that you're going to buy and hold. Now, of course, the VUG top holdings read very similar to what we see with the Magnificent Seven. The big growth stocks in here you will know by name, led by Microsoft and Apple, which makes up 24% of this portfolio itself when it comes to the ETF. So again, you're getting a big exposure to the tech side, also getting a big exposure to the AI side, which we know is coming. Now, of course, it also gives exposure to a wide outside of tech as well. Sure, the growth ETF is likely to underperform in market downturns, but just like any of the growth stocks, just like any of the ETFs do, but also when you look big picture at having a multitude of growth stocks, it's a great choice if you're really looking to grow your portfolio and really add it in the diversification. Now, when it comes to me personally, I do, like I said, own 25% of my portfolio in the VUG. It has been the best performing ETF that I have had. So I'm going to hop over. We're going to take a look at it. I want to break down the portfolio. And I know there's nothing flashy, nothing exciting about it, but overall, that is what I want. I want the consistency. I want the stability when it comes to the ETF, when it comes to investing, where I can put money in. I am not going to manage it every single day. I'm going to dollar cost average into a position, and then we're going to go from there. So let's hop over. We'll take a look at the portfolio. All right, guys. So here we are looking at the portfolio. This is our debt-free journey. This is once everything is taken care of. We put a lot of money into our IRAs. We put a lot of money into the 401k. We've maxed out those HSAs. This is above and beyond everything we have that we are putting in here with the portfolio itself. So you can see in the last 2.5 years, about 2.5 years, money weighted return is around 50%. That is right. We have seen a 50% return in the last 2.5 years. Big thing to attribute this to is the dollar cost averaging fact. When we look at 2022, which was a very down year, very difficult year for the stock market, we were continually putting more money and more money into the stock market, giving us a very good position, because in 2023, when we seen the stock market kind of rally, even going into 24, we did and had a very good position. Now, looking at the last week of the stock market, you can see we're down about 3%. So we have given some of this back, but you know what? I am okay with it, because right now, even just at a 3% discount, essentially to invest in the stock market, it is a great time. When you start looking out even further, a month, we're down 1%, but then you start even pushing it out further to 3 months, and we're at a little over 4% return, which is pretty good. And then of course you go out a little bit further to the year to date, just about the same. We're at roughly 4%. So again, it might not be a booming year for the investments, but overall, we are continuing to go ahead and build this portfolio. So looking here, we have 87,000 that we have put in here net cash. Market gains are about 13,000 plus. We do have 1,400 in dividends. We're starting to see the compounding aspect of this, the growth aspect of this, also the dividends that are being literally reinvested. Even this quarter, I believe we got around $400 of dividends that of course were reinvested on top of everything else that we're putting in there. Now for net cash flow, we are trying to get this number to a $100,000 mark. That is going to be the point. So we need 12.7 in there to actually get this up to that $100,000 mark. And then we're going to see kind of where the portfolio does go from there. Well, like we were talking about with the VUG, as you can see, interesting enough, you can see kind of the flip-flop here. So I have held the VOO since this was built. That is right. For the last 2.5 years, I have held the VOO in the S&P 500. You can see right now the gain of return is 52% in the VOO, because of course that is a much wider investment. We have 500 plus companies that make up the S&P 500, where the growth fund, or this Vanguard VUG, breaking it down a little bit further, only holds, I believe it was 218. I believe last time it was around 218. And you can see we held it for a while back in 23. Then we rebalanced all of the portfolio over a couple days and got everything kind of aligned to where it is today. We started doing purchases here. This was our rebalance. Then of course, we're sitting just over 25,000 that we do have in this account, with a 50% return in the last, well, since starting October 2022. So looking at even the time frame a little bit different on there. Now, of course, with this one, it does have a very strong historic performance. But hopping back over to the tab for the investment, like I was saying, this has performed very well. And you can see the VUG details, which I just want to kind of show you really quick as it kind of breaks it down. You can see on the daily chart, but when you start looking at 6 months, when you start looking at year to date, we're up 7.75. It shows right there. Dividend yield a little bit low, but this is not what we're holding it for. We are actually holding this for the growth factor of it. Now, again, we have a couple different ETFs, which I can actually show you real quick. So as we run through it, and to make up this portfolio, we kind of started using a 3 ETF portfolio. We moved it recently to a 4 essentially portfolio. So we have the SCHD, which again, not loyal to Vanguard, Invesco, to Charles Schwab, anyone that it is, you can see right here. The SCHD is our dividend ETF, which we are carrying. We have the VUG, which is our very strong growth ETF. We have the Vanguard, which of course is over all of the sectors and industries when it comes to the 500 largest companies within the United States. And then we do have the Invesco, the NASDAQ, the QQQM. So of course, this focuses a lot on the tech, very similar to what we see with the Vanguard Growth Fund, but it does hold a lot of companies that the VUG does not. And very similar when you look at the VUG and the VOO. So looking at these two in comparison, they do again have a pretty decent overlap within those. but the VUG holds them at a very, very different percentage on how much exposure we want to the tech sector, just based on the portfolio that we have here. And then, of course, like I had said, the VOO, or the Vanguard S&P 500, is 500 plus of the largest companies in the United States. And then the NASDAQ 100 with the QQQM rounds out the portfolio, and we just put 25% in each one. So it is a very basic, very simple portfolio that, again, has yielded, even looking since I've had this open, roughly a 50% return over the past 2.5 years. Now, I can't imagine, if we do another 2.5 years, if we're at 100% return, because remember, when you look at the multiplication factor, you should double your money every 7 years. That is kind of the rule of 7. Every 7 years, you should double what you have in your portfolio. That, of course, doesn't include the contributions that are in there. That is kind of just the growth factor that you should see over a 7-year period. Now, of course, if you can expedite that, if you can actually have it grow much faster by having it in a very strong, well-versatile investment, you can grow it exponentially faster than that 7-year rule, cutting it down to where I'm even in the VYFM or VYMO, the Vanguard High Momentum Fund. That is what I invest in for my kids. That has seen a 500% return, I believe, in 5+ years. So it's kind of crazy, again, with some of the Vanguard funds and some of the investing. But honestly, the earlier you invest, the better it is going to perform. I'm very happy with the performance that we're seeing now in this portfolio. And of course, with the market being down, gives you the ability to really buy when it is down. You're getting it at a discount. So if you're looking to invest, the VUG is a very solid way to go. So, all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think, and I'll catch you in the next video.